Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. Welcome back to the show, Rick.
Thanks, Jim. Always a pleasure.
Rick, what's going on with the Dow?
Well, it's in the process of probing a hidden pivot target of mine. You know, I've got a pattern. I use ABCD patterns, and when you use them for 10 or 20 or 30 years, you get pretty good with them. And I've got a target right now in the Dow at 32,692, and we've been as high as 32,661. So there's only a little bit less than 1/10 of 1 percentage point separating today's high from that target. And I haven't seen a trend get through a target in a pattern like this one since the Jurassic period. You know, looking back over hundreds of thousands of years of history, this pattern has never failed me. So we'll see whether the lunatic brigade can shred its way past it, because these trends, Jim, are just they're just unbelievable. I mean, you come in on any given day, and it seems guaranteed that bonds will be down, and the dollar will be down, Bitcoin will be screaming, and all the trends are so entrenched these days. And of course, we had a little bit of volatility in the Dow there, where it was going up and down 500 points, 600, 700 points a day. But as it turns out, it was just getting running room for this latest onslaught.
What's behind the Dow continuing decline when everybody says, in real terms, the economy's in a recession?
Yeah, the economy really sucks. I mean, I've got a dozen friends who have been put out of business by the pandemic, but who cares as long as Amazon and is going great guns, and the big advertising agencies, Google and Facebook, are selling lots of ads for who knows what. It's almost like a fusion reactor, you know, inexhaustible, infinite power from inexhaustible resources. So, you've got money from around the world coming into U.S. stocks. You've got companies borrowing to buy their own shares, even companies that have tens of billions of dollars in spare cash. They would rather not touch the good stuff. You know, they go in and they borrow it next to zero to buy their own shares. So that shrinks the float without having any impact whatsoever on the economy. And when you look at those, the feeder springs, really, the things that are going into the markets, you wonder what could end it all. But the only thing that seems obvious would be if market interest rates finally put the kibosh on stimulus.
Some people feel that buybacks should be banned. They used to be, I think, up until 20 or 25 years ago. Or if a company has bought back their own shares instead of saving some cash for bad times, if they need a bailout, they shouldn't get one. What's your thoughts on that?
I don't think there should be any rules governing the thievery, the outright knavery, the swindling. The stock market is just a big con game, and to pretend you're going to make it less of a carnival game if you pass a couple stupid rules about companies, they shouldn't be able to buy in their own stock. Well, it's perfectly visible. Everybody sees it. The information is there, and it's just something that the naysayers will have to deal with.
Should we have the attitude this time around, instead of 2008, where big banks and other financial institutions that would have gone bankrupt were bailed out? Should they not be bailed out this time if they're in trouble?
Oh, I think it's silly to debate it, really. Of course they're going to be bailed out, but it's conceivable that the next episode, somewhat resembling 2008-9, except that it'll be much worse, will be beyond bailing out. The last time around, all they had to do was make sacrificial lambs of Lehman Brothers and Bear Stearns, and everything was jolly good after that. But this time, we've inflated so far beyond what we saw in 2008 and 9 that it's not just going to be simply bailing out two of the most powerful financial institutions in the world. It'll be something much, much bigger that's required. So the question may answer itself, that we're going to have more to bail out than can be bailed out. And you and I have talked about some of those things. Like we all know that Illinois will have the first state pension system to go bankrupt, but the problem with bailing out Illinois' pension system, the bankrupt will become an actual fact in the next bear market. But as soon as you bail out Illinois, you've got 22 other states that are in nearly as bad a shape lined up for their bailouts. So the next bailout, there ain't going to be a next bailout because just like this is the everything bubble, we can't possibly have an everything bailout.
Well, one of my regular guests, Ted Dixon, pointed out that $86 billion of that $1.9 trillion relief package, $86 billion of that was to bail out some of those pension plans.
Yeah, but that $86 billion isn't even, you couldn't even squeeze that small a quantity out of an eyedropper. That's nothing, $86 billion. What you have really, when all the money goes into, let's say every institution, every investment portfolio manager in the whole world owns Apple shares. So when you float a zillion Apple shares, I don't know how many are out there, but that's the stock market is bailing out the pension system in a hugely larger way. I mean, forget about it, the 86 billion, just pushing the stock market up and up and up is all that CalPERS and all the rest need. So that's where the real bailout's coming from, and it's of course the unspoken bailout.
We'll have more with Rick Ackerman right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Rick Ackerman. Rick, if the Dow hits your target high, what happens after that?
Well, as I said, there has not been an instance since the Triassic period when a trend hit one of these targets from this particular type of pattern where it didn't instantly reverse. So I don't even like to talk about what happens if the Dow has to stop right here at 32,692, and as I said, it's been within less than 1/10 of 1 percentage point of that. So I guess we can consider the target filled. I had my guys buying some put options yesterday in DIA, and if we get a pullback here, we're going to spread off the put options. We bought March 26 expiration DIA 300 puts, and we're always looking to sell a put at a lower strike at the same price, meaning we'll have on a vertical bearish put spread at zero cost. So as long as we get some sort of top out up here, everything will end happily.
Is it possible or likely we're going to have another major correction like we saw around this time last March?
Well, anything's possible, and I'm always just kind of playing the odds. I don't have illusions about catching the mother of all tops to the exact point when we've got this bull market chugging along for it just as of today or so, it entered its 13th year. So the odds are always going to be against picking a top there, but there are certain opportune targets that come from my own technical methods where I do like to get short. It's irresistible to play that game, and I enjoy it. But otherwise, I'm just bullish as all get out if it blows past this target. I've got targets in QQQ up around 377. QQ is a NASDAQ equivalent, NASDAQ 100, and it's currently trading around 319. So for this thing to go to 377, it's enormously bullish, but I just need to see it get past a more imminent target, one that's closer by at, right here. And another vehicle where I'm looking for a top is IWM, which tracks small cap stocks. It's been as high as 232, but I'm looking for a top at exactly 234.82. So I'm still just a little bullish, and I would be a put buyer if it gets there, but with real tight stop losses. And if we see, within a few days it just blows through that target, I'd be crazy bullish.
A survey found that millennials that are receiving these stimulus checks now, $1,400, perhaps some unemployment benefits or some kind of other government assistance, around half of them plan to put it into the stock market. Should they kiss that money goodbye, or is it a good plan?
I think it's great, really, that they're going to learn their lesson early. It's good that they're taking their money and they're blowing it on, who knows, maybe they'll put it into GameStop or something, or Hertz Rent-A-Car. So I think it's a wonderful thing that they're going to learn that stupidity has consequences, and better that they should find that out at the tender age of 36 or 37. However, apparently they're still living with their parents into their late 30s, but better they should figure that out now than when they reach middle age.
What about older people? Should they be involved in the stock market, or do you have any choice with such low interest rates?
No, nobody has any choice. The low rates have really pushed everybody into risk, and everybody's stretching for yield. And even if you've got your money in some conservative fund, they probably have a piece of it sunk into Bolivian reverse floater swaps or something like that. So yeah, there's no avoiding being in the stock market in one way or another. We're all there, whether it's our life insurance company that has invested for us or whoever else. So we've all got our proxies active in the markets now.
We'll have more with Rick Ackerman right after this.
AVN Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol AVNAF. Surrounded by world-class gold deposits and mines, AVN's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avnresources.com.
Informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Rick Ackerman. Rick, do you have any theories about why junior gold miners are not doing well, whereas Bitcoin with no assets behind it is still booming?
Bitcoin is really the mania of this age, and it's really drawn all of the speculative fervor that might otherwise have gone into gold. That's all there is to it. There's no, when you see the whole commodity complex going nuts because of quote unquote inflation fears, and you see Bitcoin going up for the same reason, and gold is just kind of biding its time. You know that, well, there's a serious error of misjudgment there about what's going to have value, if some crisis strikes. But anyway, yeah, gold and silver being neglected in favor of Bitcoin. As far as why the junior miners haven't moved, they're really at the tail end of the spectrum of optimism, and you need to have crazy optimism before you can budge some 37-cent penny stock with properties in Uganda or somewhere. It'll it'll happen eventually. But right now, you don't have anything like speculative mania. In fact, gold and silver are they're quite placid. Not in bear markets for sure. As I said, they're just kind of biding their time till the speculators in Bitcoin develop a better understanding of values.
Is crude going to continue to climb?
I don't understand crude really. There was a time when I used to say, would tell you that that mere curtailment of supply is not enough to drive a bull market in crude, but that's what we've got. It's not like the demand for energy is going bonkers in a booming industrial world. There's a lot of smoke and mirrors behind China's recovery, and China is really the margin pricer of the buyer at the margin, setting the price of crude. So I don't think China's having that kind of recovery. So, crude is just, I guess, moving higher on that inflation speculation. So I don't even know where the top is. I would say that it was getting kind of, who knows what the proper value for crude is, but I think it's gone pretty far without any corresponding growth in demand.
Rick, many people are predicting inflation, hyperinflation, because of all these government checks. However, you have a different theory. Can you tell us about it?
Yeah, anybody who thinks hyperinflation is even remotely possible ought to read Adam Ferguson's When Money Dies. The German hyperinflation took place in a local currency, the D-mark, and it was certainly not a global reserve. And the mechanism was really one that allowed physical dollars to arrive by the boxcar load at the biggest employers in Germany. Germany had close to full employment in 1921, which was somewhat ironic because, the Allies that had beaten them in World War I had hideous unemployment. So the German economy was relatively strong before hyperinflation took off in the spring of 1921. But it was by previous arrangement with between government and the largest employers that if the German printing presses should fail on payday or sometime before payday, that the employers themselves could print their own script. So the peak, the couple biggest spikes in hyperinflation in Germany over the 1921 to 1923 period, 1924, were those times when the German money printing presses were actually broken down and the employers were issuing their own script. So the Weimar hyperinflation was very much it was real dollars, it wasn't a digital phenomenon or wasn't a central bank inflating the way we do. It's very easy to inflate asset prices, but, the method by which the Fed creates inflation, it involves borrowing. The money just doesn't get out there. It does with the stimulus checks, but the stimulus checks are nothing really. They're not even a drop in the bucket compared with the much larger forces that are potentially deflationary. So, which arise from a condition of debt. The more we owe, the more powerful the eventual deflation will be. And yeah, you could hyperinflate your way out of it, but I keep making the point that you can't do that. I mean, if you take one area that is black hole power deflation, it would be the pension system of the U.S. Now, if you try to imagine how the U.S. government, quote unquote, rescues the pension system, you understand why it can't happen here. Everybody says, well, the government will have to bail out Illinois. Well, first of all, in that context, I always tell people to substitute the word taxpayer for government, because that's what it is. Our government doesn't even exist other than the fact that it has your dollars to spend. So, so when you talk about a government bailout of Illinois, which will be the first state to go, whose pension system will go bankrupt, you understand it can't happen. I mean, you're in a situation where the quote-unquote government is sending out, let's say, 1.7 million checks every month for sums ranging from $800 to, let's say, $2,200. All right, and you can imagine how for how many months can that happen, that the government's just sending checks out to Illinois, former retired government workers. So you can't inflate that way. That's literal helicopter money. And as I said, once you start bailing out in Illinois, you're going to have New York, Connecticut, Rhode Island, California, 22 other states knocking on your door looking for their handouts too. So that is a deflationary juggernaut. It's a black hole of deflation, our pension system, and there's no way they're going to be able to bail it out. So, and the other example that I always use, to people who think we're going to get hyperinflation, well, that would effectively bail out debtors. It would mean that your $240,000 mortgage, you'll be able to pay that with just a couple of hyperinflated bills that you pull out of your wallet. So do you honestly believe that mortgage lenders are going to get stiffed like that the rules are going to allow that to happen? Of course not. And to the extent that whatever the future holds, it does not hold the possibility of mortgage borrowers being allowed to skip and go free. They're always going to be, we collectively, all debtors, all Americans, will be encumbered by debt. And that's really, the condition of deflation is really how you need to define it. Forget about the droolers, the monetarists who always talk about, inflation being an increase in the money supply. That's a lot of crap. We don't even know what money is. There's so many fungible forms of it that it's ridiculous to even try to measure it. But, we can't get to the point of, thinking our way through it. We can't possibly inflate debtors out of their problem. And ultimately, all debts must be paid. What people miss is that if they're not paid by the borrower, they're going to be paid by the lenders. And the lenders have all those zeros on their balance sheets. They count as the net worth of America, the asset value of America, but a lot of those zeros are going to come off the books in bankruptcies and liquidations, and all of our mortgage contracts are going to be eventually rewritten as leases. That's the only way things can play out, at least the only way I can imagine.
Rick, you have a webinar next Friday, March 19th at 10 a.m. Pacific at 1 o'clock Eastern Time. What's that about, and who's involved?
Well, you are. We talked about that yesterday, and I think it's great that you've offered to we'll make it a Q&A, and this will be all about deflation, everything you need to know, and a couple things you can do to protect yourself from what's coming. And it's really, I hope it's an eye-opener, because my perspective on deflation is a little bit different from all the other stuff I read, and most experts are really on the inflation side. They see the stimulus going on, and they think that it can only lead to inflation. But I'm going to explain why the opposite is true, and why the one thing that everybody's bet on can't possibly be a winner simply because everybody's on the same side of the bet. So, Jim, I'll be interested to chat with you next Friday, and we'll get it all out there just so that people can have, the listeners can have a really good understanding of what's coming.
How can people participate in the webinar?
Well, we're gonna cross promote that. I'm gonna put out a mailing to I mail to a pretty good sized list, and I'm gonna invite all my subscribers, and of course I invite you to invite all your listeners. It's gonna be very informative.
Rick, thank you so much for chatting with us.
Always a pleasure, Jim. I appreciate your inviting me on.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. He was speaking to us from Florida. If you have any questions for Rick or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.